The Fed stood pat as widely expected, and despite more abuse hurled at the Fed chair from a toxic POTUS. What changed, however, was their read on the economy, which they now expect to grow slower, have higher inflation, and higher unemployment. In numbers, GDP forecast cut to 1.4% from 1.7, inflation to be 30 basis points higher, and unemployment at 4.5% instead of 4.4. Importantly, median rate projection for end of the year in the dot plots has two rate cuts, but it's a divided Fed with only about half of the governors in this camp and 7 of 19 governors expecting none. While we understand their obsession with inflation, we also believe they are underestimating the threat to growth. Not surprisingly, equities and treasuries sold off post Fed while the dollar and gold rose. In a separate move, more sabre rattling raised fears of a US involvement in the Israel Iran conflict, driving oil prices higher. Importantly, volatility is rising again. We continue to believe that the biggest risk to risk assets is not just volatility itself, but also the volatility of volatility. This probably impacts equities most and benefits gold, but only after we exit current congestion zones. To reiterate, S&P needs to resolve 5800 to 6150 range, while for gold the range is 3250 to 3450. As bonds go, yields are similarly stuck between 4.25 to 4.5%. Connecting the dots of weaker growth and higher volatility, we expect equities and yields to resolve lower and gold higher. Using volatility opportunistically to both protect portfolios and collect premiums is likely to be a more fruitful pursuit this year rather than directional moves. Like, subscribe, and share. Good morning. This is Sunil Garg from Lighthouse Canton.